Um, Today we'll be discussing what's been happening in the markets and the impact of events on clients' investments, and typically what an investment manager might be considering when looking after all of our clients' monies. I think it's safe to say we go into 2024 with inflation falling and the expectation of global central banks easing monetary policy. And then the knock-on effect is obviously anticipated interest rates coming down. We've seen that with HSBC and Santander reducing the rates over the last week or so. It's also interesting to know over half the world's population will go to the polls this year. So political uncertainty, which I'm sure Alex will touch on, will be a factor in driving market sentiment and values. Just before we start, some basic housekeeping. Can we make sure that to mitigate all background noise, we're all on mute, please? The presentation has been recorded and will be available online and also via our YouTube channel. The webinar will last around 40 minutes, and also, as I said before, there'll be time for questions and answers at the end, but feel free, because of the new format, to ask as we're going along. So Alex, just to start off, would you like to give a brief update of what's been happening and what we think is going to be happening with economic growth in the UK and globally?
Yeah, good morning, everyone, and Happy New Year. It's certainly been a bit of a bumpy ride over the last few months. Economic growth has been, in the UK anyway, has been dancing around zero. I've just got a chart actually, which I'll just share just to highlight this and just to show kind of how volatile economic growth has been in recent months. So this is from the Office of National Statistics. It's just the last year. You've got UK economic growth and the different components which make up the bars. And then the line symbolises, well, what's the monthly GDP? This is monthly, not quarterly. And as you can see from this, it's been dancing around zero for basically the last year. This high inflation, cost of living crisis that we've been going through is certainly impacted, but it's been very volatile in both directions. November was actually a bit of a surprise. So November GDP came in the UK at 0.3. But you can see there that was bouncing back from a contraction in October of a similar level. So economic growth is basically flatlining in the UK. Services is a key component. You can see that light blue bar and how that drives the overall impact. And that is because the UK and most developed nations are service-based economies. And then just to put this into context then, so this on the left-hand side is just a slightly longer chart going back to 2012. And you can see UK growth averages around 2% in normal times. Clearly, COVID and the pandemic and the reopening was not a normal time, and that's why that heart monitor jumps in there. But so the UK growing at around zero is below trend of 2% growth. On the right-hand side, because GDP comes in with such a lag, as I mentioned, we've only just got November GDP recently, so we're a few months behind. What we do as investment managers and what others do is look at these PMI indices, purchasing manager indices. That's that purple line on the right-hand side. That gives you a real good indication of what's going on with the economy right now. So it's the grey line. And you can see right towards the end of that chart, it's just dipped below zero. So that suggests that the economy is slightly contracting at the moment. Now, the World Bank, the IMF, the Bank of England, they all have forecasts for economic growth. And for the UK this year, it's modest growth of 0.5%. So the UK economy is probably bouncing around recession. If we do have a recession, it's likely to be very mild. But this cost of living crisis and high inflation backdrop that we've going in has really stopped the economy, but it's not pushed us into recession, which is a positive. So, and Stuart, just to answer your second part of your question, what's going on globally? Well, you can see here what the consensus forecast, and as I said, the UK outlook isn't very positive, but it's not expected to go into recession. It's just meant to be similar to what we've been going through the last year of kind of bouncing around zero. But globally, it's a similar picture. So those bars on the left-hand side, so 2023 and the forecast for 2024, as you can see, all of the purple bars are below the grey bars. So everyone, most economists anyway, are expecting economic growth globally to be weak. And then on the right-hand side, you can see those purchasing manager indices of different countries. They have been improving slightly. The US and Europe bounced back slightly. So again, it's a mixed picture in terms of what's going on with global economic growth. What can I say though? So if you're looking at the US really surprised last year because you saw people using savings that they built through COVID, and that really spurred on the economy last year. You also saw the US government spending a lot of money last year. They've got a massive fiscal deficit in the US to try and stimulate the economy. And that can't go on forever. You can't keep having a big fiscal deficit, and consumers can't keep drawing down on savings. So I do think within the US, it's natural that you're going to see economic growth slide because of that those impulses from last year starting to wane. If you look at China, China's certainly been going through a period of slower growth. It hasn't reopened at the same speed as everyone was expecting from their COVID restrictions at the end of the previous year in 2022. And that's really had an impact on the global economy because the US and China are the two major superpowers that drive global growth nowadays. And if China's slower, then Europe's slower. So there's parts of Europe, particularly Germany, that are probably in recession already. So we say the UK backdrop doesn't look great, but compared to Europe, we're actually doing pretty well at the moment. And Europe's been really impacted by this slower growth coming out of China. Now, what can happen going forward? Who knows? But you are going to see, as we said, a period of central banks starting to ease, and that could be stimulative for growth as we move through this year and next year.
So, Alex, I suppose that's a dichotomy at the moment where we've got world economies that are hugely in debt, and they have to they have to pay back that debt at some point. And one of the ways of getting out of that debt is obviously higher inflation because you can inflate your way out of it. But the flip side of the coin, that has the opposite effect for stimulus with regards to the economies and getting investment in there. So would you say the period of high inflation is over, particularly when we're thinking about the general elections that are coming up both in the UK and the US this year?
Yeah, so I mean, again, inflation has been falling. I wouldn't say the period of high inflation is over in the UK. It probably is in the US and maybe parts of Europe now. But the UK stands out as having slightly higher inflation versus the US and China. Because we've still got inflation figures which are still pretty high, still well above the Bank of England's 2% target. That being said, it is falling very quickly and is expected to continue to fall quickly as well. So let me just share this slide. Here you go. So this shows the breakdown of UK inflation. And you can see quite simply from this chart, it's coming down just as quick as it went up. So this goes back to 2021. The orange line shows what the total CPI is, and then the bars represent the different components of it. And more recently, on the right-hand part of that chart, you can see there's some bars which are below zero, which is electricity and gas. I mean, compared to last year, we're not spending as much on our energy bills. Fuels, the oil price has fallen over the last year, so that's been a slight negative. But you can see that oil, and that's probably a key point to talk about later, the oil price doesn't really dictate inflation too much. But crucially, those other bars are also starting to come down. Services are starting to come down, core goods, food and alcohol. They're not having the same impact that they were last year. So all areas of inflation are starting to fall. And that's what's happened. This is, economists are very good at saying what's happened, but they're not so good at telling you what's going to happen in the future. So just to combat that criticism, this is from Lazarus Economics, and this is their prediction of inflation through this year. And this just looks at the base effect. So it looks at the price, what it was last year and what it was today. And you can see here that inflation is going to continue to come down. They've got the April and May readings of just over 2%, which is bang in line with the Bank of England's target. And you can see it's expected to be low throughout this year as well. So inflation story isn't over yet. because we're still well over the Bank of England's target, but it is looking like inflation will come back to the Bank of England's target this year. And that's critical because that means that that takes the pressure off the Bank of England. The Bank of England have got a dual mandate. They want stable prices, but they also want a strong economy. At the moment, the inflation target is coming back into normal levels, and the economy, as you said, they probably want to stimulate the economy at this point because we are flirting with a mild recession, but economic growth is very weak. And over the course of the next few months and this year, you're still going to see the impact of interest rates going up coming through. You know, a lot of people still haven't remortgaged, and that's going to be coming through. That's going to hit disposable income. And as I mentioned, we're a service-based economy. And if we've got less money in our pocket, then that's going to impact the overall economy. So that's why it's amazing, really. I mean, this time, 6 months ago, everyone was saying interest rates are going to keep going up. Interest rates are staying high for longer. You fast forward 6 months and everyone's saying, well, interest rates are coming down now. We've gone past the peak. It's amazing how quick mindsets have changed with regard to interest rates.
Well, I mean, you mentioned that, Alex. It's both Hugh Pill and Andrew Bailey have both said that interest rates will remain higher for longer. But there is talk out there of the expectation for possibly the Bank of England to start reducing rates, even although a couple of members are still of the opinion that they should increase. So it seems the Bank of England aren't sure what should be happening with interest rates. So do you think interest rates have peaked? Do you think rates will start to come down? Do you think that will follow through into the high street and into consumers' bank accounts and spending?
So it's an interesting one, that. And I think the Bank of England haven't said anything about interest rates coming down yet, but the Federal Reserve have. And that's because their inflation target, they're closer to their inflationary targets than we are in the UK. So I do think it's only a matter of time in the UK that the Bank of England rhetoric starts to change. I think they have to be tough at the moment because when you've got inflation still running quite high, they can't wave the white flag and say everything's okay. They need to see inflation coming back into target before they can start to change their narrative because they won't want to try and change that. And we had wage inflation data out today as well, and that came in weaker than expected, which is a positive because if wages keep going up, then that's going to be inflationary as well because then people have got more money. So I do think, as I kind of highlighted, we are at the end of this inflationary cycle, and I do think we've hit the peak of interest rates. So we've had 3 months now where the Bank of England are paused. The next meeting is the 1st of Feb. I wouldn't expect them to be cutting interest rates then. But as I mentioned, maybe as we go into the summer, there's a good chance that interest rates could start to be coming down. And I think they need to because the economy at the moment is struggling. And that would be stimulative. So that's going to have a lot of impact. So that's going to impact people's debt. So the biggest one that we have is mortgages. The next one is clearly the rate that we receive on cash and bank accounts. So that's going to have an impact. That's been a positive to the economy, strangely, because people's bank accounts change quicker than their mortgages do. So it's actually been positive that interest rates have gone up because we do have a lot of savings as a nation. So us all receiving a bit more interest has been a positive and is stimulative. But as I said, yeah, I do think that interest rates are probably too high. So the Federal Reserve, just to give a kind of bit of context, have said that they expect their natural rate, so when things are normal, to be around 2.5% to 3%. So it's about double where we are today, and the UK won't be too dissimilar from that. Maybe 3.5, perhaps, will be the natural rate that you'd expect. I can't see us going back to that period that we went through between 2008 and 2021, where it was basically zero for a long period of time. I don't think that's healthy. I think that encourages people to take on too much debt. And I think it's natural to have, the money should cost something. So that's where I'm at, kind of that 3.5% level within the UK. So if inflation gets back to target, they're looking to Bank of England looking to get to stimulate the economy, then 3.5% seems an appropriate level to me. So you can see there's quite a few cuts there to get from the current 5.25 level that we're at today. Now, the flip side of that is if we do have a recession and it's a more severe one than I'm expecting and others are expecting, then you'd expect interest rates to go below that 3.5% because then they'd be looking to stimulate. But maybe it gets to 2 this time. I don't think they get down to 0 again.
And that's one of the problems, isn't it? That if you've only got a hammer in your bag, everything has to be a nail. And the Bank of England have only got one tool, which is looking at increasing and decreasing interest rates. But they're not by themselves. The Eurozone are having the same discussions. Japan's talking about going from negative interest rates still to positive. The emerging markets are looking at what they can do around interest rates. But I think the big impact, particularly for clients, is what do you think the impacts will be on house prices? Because we've seen a little bit of stagnation within the residential housing market.
Yeah, so that's a good point. And everyone likes talking about house prices because it's one of their biggest assets. So I mean, last year wasn't great for house prices. Interest rates going up, mortgage rates going up. That impacted the people buying properties, and that ultimately pushes property prices lower. In the short term, though, over the last few months, it does look like things have stabilized a little bit. You've seen house prices increase. So there was some data out yesterday, and that suggests that house prices have started to go up a little bit. And again, mortgage rates are coming down. So mortgage rates don't follow interest rates. I know that's a weird thing to say. Mortgage rates follow very much what the gilt market's doing, and the gilt market's thinking, well, what are interest rates going to be in the future? So there is a connection to interest rates, but it's also looking forward. That's why if you go back to the Truss mini budget, then mortgage rates went a lot higher, but interest rates were lower at the time because gilt yields really spiked. But gilt yields have come down significantly over the last few months because myself, other investors are expecting that interest rates will come down in the future. And if that happens, then mortgage rates will continue to come down as well. So that should provide some support to the housing market. I think the other key point as well is that there's just not enough property within the UK. There's not enough supply coming through, and demand is still very strong. So naturally, that's why house prices probably haven't fallen as much as everyone's expected, because you've got that natural demand issue coming through and a lack of supply. So that's, as well as mortgage rates, it's also important just to think about that in terms of the backdrop of the housing market in general.
And I suppose that's a whole discussion at the moment with regards to inflation, interest rates, the effect on clients' cash deposit rates, and also gilts. Is a lot of our clients, particularly over the last 12 to 18 months, have reverted back to cash rates where they're getting 5, maybe 6% in the middle of last year. But that's probably a short-term holding for a long-term objective, if that makes sense. So they reverted to cash in the short term to get the 5% because investments have been a bit stagnant. But in the long term, that's possibly not the right decision. Would you agree?
Yes, I mean, it depends on the time frame as always. So if someone needs money in 6 months' time, you certainly wouldn't recommend investing. And you kind of touched on it there. If people are willing to take a longer term approach, then the statistics there for all to see that you tend to deliver better returns from being invested over the long term, like you say, and riding through these periods of volatility. And because interest rates have changed, and you are getting, as you say, an attractive return from cash deposits at the moment, but you're having to get more attractive returns from every asset class because that's changed. And you just have to look at something simple like the UK government bond market. So I'm just going to share this chart with you now, Stuart, as well, so everyone can see this one. Just go through that, just ignore that. It says interest rates, mortgage rates there. So apologies, this is quite a busy table. But what this shows is just the different government bonds that are available on the market at the moment. So the first left-hand column just says the name of them. Then you have the maturity date. So when they're going to pay back the initial investment. You've then got the coupon. You've got the current price there. So you can see they're all below £100. And then you've got this column here, gross redemption yield. What the gross redemption yield is, it combines the coupon, but when you buy a government bond, it's issued at 100 and it matures at 100. And as you can see there, all of the bonds are below 100 at the moment. So the gross redemption yield includes the recovery in the price to 100 plus the coupon. Now, if you're looking at the coupons, and I'm just going to highlight one here. So you see this 2025 one here. It's got a very low coupon of 0.25. And because of that, it's priced at 95 today. So most of the return that you're going to get is a recovery in the price going back to 100. And that's why it's getting a 4.5%, 4.48% return over this time period. You can see here that the kind of all of these bonds put together, you're getting a gross redemption yield on average of around 4%. Oh, goodness me, sorry. But the beauty of buying gilts, that recovery in the price from 95.84 to 100 is completely tax-free. So basically, a lot of the return that you're going to get from buying a gilt is tax-free from income tax perspective. Now, if you have cash and you've got cash in the bank and you're getting 5 or 6%, that isn't tax-free. That is all taxed at your marginal tax rate. And here you can see the return that you need to get on cash to get the same return. So if you're a 20% taxpayer, you need to be getting cash at the bank of 5.2. If you're a 40% taxpayer, 6.87. So you can see there that the returns that you need from cash, yes, it says 5 or 6%, but you need to remember that is being taxed. Whereas if you're buying a gilt today, that isn't being taxed. And gilts as well perform very well when interest rates are starting to fall. 2022 was a horrendous year for the government bond market. You lost 25% of your money in gilts, staggering. And that's because interest rates were going up. Now, interest rates start to come down. You can see the opposite and the reverse happening. So I'm just going to go to this chart here. So on the right-hand side here, you can see the return that happens as yields change. Now, this is the US market, but it impacts the UK as well. So that left-hand bar, a 10-year US government bond, the yellow bar, if interest rates or yields go down by 3%, which is that 300 basis points, you can make nearly 30% from buying these securities as well. So for us, you're getting an attractive return, which is better than cash. You're getting good diversification in portfolios. If interest rates come down, then you stand to make good investments and returns. And on this chart here, just looks at, well, what's happened at the end of, this is the Fed hiking cycle. And the dotted line shows the last hike, and it shows the different markets that we've gone through and the different returns. So the left-hand side looks at the S&P 500. And you can see there that 99, 2000 stands out. I mean, that was the tech bubble, so it was a bit different. But most other instances, after the Fed has finished hiking, stock markets perform better, and it's because it's stimulative to the economy. And then on the right-hand side, there's even a more stronger chart. Now, what money do you make on government bonds? And you can see that in every instance when the Fed have started to have got to their last hike and then start to cut, you can see you've always made money from buying government bonds, and that's a 2-year period there. So yes, it's been a volatile period.
Alex,
Sorry.
that's roughly where we are at the moment, would you say?
Yeah, absolutely. I think, as I said, I think we've gone past peak interest rates, and as I mentioned, the Federal Reserve have already said that they're thinking about bringing interest rates down. So yes, I think you can make historically, you've made decent returns when interest rates have peaked in both, well, definitely in bonds, sometimes the majority of the time in equity markets. And on the flip side, like you say, those days of getting 5 or 6% interest on your cash might start to disappear in the future. And one final chart on this, and you can see I'm quite passionate about this one at the moment, Stuart, but this also shows when interest rates have peaked in the past. And again, it's the US. So you can see the line there, that's when interest rates are going up or going down. What the blue bars then looks at what happened after that. Did bonds outperform cash, or did cash outperform bonds? And in those 5 instances, when interest rates have peaked and they start to come down, bonds have always outperformed cash. So again, history suggests that it's a good time to be invested in bonds at the moment, because it tends to do well as interest rates are being cut.
Just comparable, we've mentioned the comparability, if that's a word, excuse me, against cash rates. What about the security that clients can be looking at? Are they liquid? What's the what are the chances of clients losing money because the gilt's lost, for want of a better expression? Do you want to just touch on that?
Yeah, it's a great point, Stuart. So gilts are the most liquid investment in the UK. You can buy and sell a gilt every single day, and it settles on after 1 day, T+1. So they're very liquid investments. Essentially, when you're buying a gilt, you're giving the government are borrowing money. That's what they're doing. The government are looking to raise money and borrow, so they issue gilts. So your risk is that the UK government defaults. I think there's a very low probability that the UK government would ever default, and they haven't done in the past. That's obviously a higher risk when you're looking at emerging markets and other countries, and they have historically defaulted. But you'd expect to be getting a better and higher return to compensate you for that risk. So equally, you've got money in the bank, which the banking system is very safe. We clearly went through a bit of a stress period last year with the US regional banks, and the UK banks didn't even wobble in that because the UK banking system is very strong because it's been rebuilt and forced to be more liquid after the financial crisis. So you can have money in a UK bank account, which is safe, but you could argue that money in the government is even safer because the government are a safer entity than a bank. So yes, I would say there's even greater security by buying a government bond because of the fact that you lend into the government, and it's very, very liquid. And one thing maybe I didn't touch on, Stuart, which is important, we didn't have a lot of bonds in portfolios in 2022. Which was the right decision because that was the area that was the weakest. Bond markets fell more than the equity market. And over the last year, through last year, we really increased our bond holdings. So we've had very low allocation to bonds in portfolios for a long period of time because interest rates were low. Interest rates were low, the returns that we were getting on bonds were very low. But over the last year, with interest rates normalising, we've been increasing our allocation significantly because the returns there are so much more attractive than what they were in the past.
And I think it's worth mentioning for clients, excuse me, I'm just getting over a cold, that you mentioned about banks capitalising, recapitalising, but a lot of companies since COVID have recapitalised as well. They sat there with a lot of cash that they might be getting 4 or 5%, which obviously is going to be taxable by their accounts. But companies can hold bond portfolios also. It doesn't have to be in your own personal name, does it?
No, absolutely. No, and yeah, I mean the tax rules are slightly different for corporates versus individuals, so you don't benefit from that capital gains tax increase from the prices and income tax. But yeah, you can hold them in a variety, and we've been opening a lot of gilt-only portfolios recently as well, where people are just looking for the security of it, and that's both at a charity level, it's at an individual level, it's at a corporate level as well. And it, the whole point of Luna is to be bespoke. And so when we're speaking to individuals, we're finding out, well, so let me just share this screen back again. I'll just maybe just be useful to talk through this slide. I'm gonna go back. Can I go back? I can go forward, but I can't. Here we go. So back to this table here. So you can see here that there's so many different gilts available. So if someone had, say, a tax bill which was due in January 2026, you could just go out and buy that specific gilt. Again, it's back down to what individuals' needs and their requirements. So that's the beauty of Luna, that we can be bespoke and we can build things individually to each company or individual.
So for clients and introducers that are listening in, I've had quite a few clients that sold their businesses this year. The capital gains tax bills due in January 2025, and we've done exactly that, looked at buying a specific treasury bill to mature in January to pay for the tax bill in 2025. So if anyone wishes to discuss anything along those lines, feel free to speak to your advisor or Alex. It's a bit of a plug there, but it's probably worth getting in at this moment in time.
Yeah, and like I said, Stuart, I mean, for individuals, I don't think people realise those tax benefits, and I think that's one of the biggest points to mention at the moment. Those tax benefits are significant, and they're not widely known by the population. So it's one topic that we consistently will talk about because it's really important and that people make good, sound investment decisions.
Good, thank you. So moving on, something that we've consistently spoken about over the last 12 months is the impact from the general election in the UK and obviously from the US general election. Do you want to just touch on what we think? Because we've looked at what's happened over the last 3 years, 2 years, etc. We've had a look at where we are today in terms of interest rates, inflation. But moving forward, what can clients and investors expect, particularly with the UK general election and the US elections, about the primaries that are ongoing at the moment?
I was hoping you weren't going to ask that question, to be honest, because I don't know. This answer. There's just so much. What's that? Sorry.
Okay, let's move on.
No, I'm joking. I'm joking. No, what can I say? I mean, first off, we don't know when the election's going to be. It looks like it's likely to be kind of autumn time now, which would be kind of coinciding closely with the US election as well. The current data is sort of suggesting it looks like Labour are going to get into power. What I've seen in the past from the other elections that have been through, it does cause some short-term volatility in markets because of that uncertainty. Markets like certainty, and with an election, there's a degree of uncertainty in just for a short period of time. So in general, markets tend to fall maybe 2 or 3 months beforehand. Coincidentally, though, markets tend to rally afterwards because after the event, you've got the certainty. And to be honest, I don't think the volatility around these things isn't significant. I think either party in the UK that comes into power, there's not really a lot they can do because of the levels of debt that we have. And that doesn't really tend to be an impact on global markets. I mean, if you think about on the UK market, so the FTSE 100, 75% of the earnings in the FTSE 100 come outside of the UK. So you've got 25% of the FTSE that could be impacted. What tends to be impacted more during events like this, and we saw it with Brexit, is sterling will be impacted. And that could be a positive or a negative, though. So if sterling's weak, I mean, it's horrible if you're going on holiday. You feel like you're spending more on your holiday. But it's actually a positive for UK corporates because they're repatriating those earnings for overseas at a better interest rate for them. A better exchange rate, sorry. So that's what everyone missed during the Brexit vote, that sterling was the release valve. Sterling crashed. And actually, FTSE 100 companies were a lot more profitable on the back of that as well. So the reality is that it could have a small impact on markets. Markets don't like certainty, don't like uncertainty, etc. And I just want to bring another chart in here. You know I love my charts, so apologies for that. It's this one, and I don't have one on the UK, unfortunately, but I do have this one on the US. And clearly we've got a US election. I'm hoping that you don't ask me a question on that as well, because the UK seems a bit. At least we know which parties are going to be in, or individuals are going to be in front with the UK. We've got no idea who's going to be in charge in the US and head of the Republican and the Democrat Party. I mean, Trump is the big question mark, as we know. But what this chart looks at, it looks at the different parties that have been in, so Republican in red and Democrats in blue and a divided government in grey. At the top chart, you can see, what was the economy? How did the economy fare in that environment? And then the bottom chart shows how the markets did, the S&P 500 specifically. And there's no real correlation there. I mean, you have good periods of economic growth in both parties. You have recession with both parties. Markets perform strongly with both parties, and markets perform weakly with both parties. So there's no real connection between politics and stock market returns. The kind of point to the exception to that, though, was probably Trump. And I've missed talking about Trump for such a long period of time. But Trump, when he first came into power, was very pro stock market, very pro the US economy. And that was a very good year to be invested. But then that turned on its head because then he decided to go have a trade war with China, which impacted global growth and gave uncertainty, and investors were nervous during that environment. So we don't know what party's going to, we don't know who's going to be running in the US, sorry. We don't know who's going to be the leader of the parties. And even if we got that right, the market impact could still be different. So in the short term, the uncertainty could lead to a little bit of volatility, but we can't get dragged into that noise. I mean, it's interesting to talk about, but again, we just need to stick to our fundamentals of picking good long-term investments that can deliver regardless of what political party is in power, whether it be the UK or US. I think, we spent a lot of time talking about the UK and US, but you touched on it right at the beginning, Stuart. Like 50% of the world's population are going to the polls this year. So it's just as important to see what's going to be happening globally. So Taiwan elections happened at the weekend, and that's caused some volatility in markets already. But there's India have got big elections this year. The Indian economy's been doing very well. The Indian stock market's been doing very well as well. So it's just as important to focus on this as a global and not get too suckered in to this small island and what's going on across the pond.
There's a question that's come in just on, excuse me, the UK elections, and it's saying that neither party have got, it's what you were saying before, much manoeuvrability. So actually, there's very little that can happen, but possibly the best thing that can happen is a landslide, a large majority for Labour, and then people can, that Labour can look at a long-term economic development plan, which is probably what we're looking for growth in the economy.
Yeah.
A bit of sustained growth, and as opposed to this reactionary temporary politics that we've seen for the last, I don't know, possibly 8 years.
Yeah, I think really what the UK needs is stability. We haven't had stability in the UK now since Brexit. We've had so many different prime ministers, so many different chancellors, things chopping and changing. And what the UK needs is stability. And I think we sort of have it a little bit at the moment, but in terms of since Rishi came in. But I do think as well that, this general election, that kind of puts that question mark back over that as well. You need long-term plans and you need stability in government. And I think if you get that, then that improves the UK's credibility on a global scale. I think that's why sterling's been so weak in the UK market. We can touch on that later. The UK stock market has not been great versus global peers since Brexit because there's been question marks about what's been going on in the UK. And if you get that stability, you get that confidence back, then that's key. That'll be key for sterling, and then that'll be key for the stock market as well.
I think it'd also be key for perhaps the small, medium-sized companies, the S&P, the FTSE 250, because there is value there, isn't there? That there's some good, strong companies with good balance sheets that are trading well with, PE at a reasonable level, and perhaps just that little bit of stability will see that sector within the UK increase in value.
Yeah, absolutely. I mean, it's mid and small cap companies have been under pressure the last 2 years. They're a lot more sensitive to the economy, the UK economy. So I mentioned 75% of earnings in the FTSE 100 come from overseas. It's about 50% for the FTSE 250. So you do have a bigger reliance on the UK economy. And if you go down to smaller companies, it's even bigger in the UK. So yeah, you want to see the UK performing well. But like you said, those companies have fallen significantly. And I'd say that the share prices and the valuations of those companies now is almost reflecting that a recession's priced into those businesses. So at the end of last year, when markets really started to perform well in November, December, they performed very strongly. So it's been interesting to see that, you see interest rates potentially coming down. They're the areas that bounce back, and they're probably the cheapest areas of the market at the moment.
You mentioned a recession, and we don't want to worry people out there. If there is, it's not going to be this huge, deep, entrenched recession, is it? It's more than likely going to be a technical recession where it will be the factors that define what a recession is, as opposed to the economy collapsing. Would you agree?
Yeah, I think we've been talking about recession for about 15 months. Because when we were coming into last year, the big question mark was, is the UK going into recession 2023? And it didn't materialize. I mean, growth wasn't great, but it just didn't materialize. And if you think about what we were going through last year with the high inflation environment, then if we were going to go into recession at any point, it probably should have been last year because the inflation was running so high. As I touched on that chart that I showed from Lazarus. It's expected that through this year, inflation is going to be more normal. So that headwind that we've all been going through is going, which is a positive. So that should be a stimulative to the UK economy as well. And if you get interest rates cuts as well, then that should be stimulative as well. That being said, who knows? Because there's always events that can come through that can impact an economy at any one point. No one was expecting COVID as we went into 2020, and clearly that look at the disruption that caused within the markets and like our own lives. So I'm not expecting a severe recession. If we are going to be having a recession, like you say, it'd be quite technical and 2 quarters of negative growth. It looks like the final quarter of last year might be the first. So we could technically be in recession now, but it's at the moment, it doesn't feel that it's going to be a severe recession. We had unemployment data out today, and the employment market's very strong as well. So there is a lot. I know we like to be pretty negative and highlight the bad news in the UK, and I think the press do a very good job of that, but it's not all bad news out there.
And just touching on inflation, it's worth mentioning that the way they work out inflation, we've had one spike, and now because it's measured in the last 12 months, then it looks as if that's stabilised also. Would you agree?
Yeah, like I said, I mean, you just look at the energy prices. So last year we were paying a lot more on energy bills, and this year we're paying a lot less. So that's why those bars were below zero and deflationary over the last year. And there's probably more of that to come through as well, not just from electricity, but hopefully food, alcohol prices, services prices as well. And I think the other point to mention as well is because we were going through a period of high inflation, companies took advantage of that. And I know, apologies if you've heard this story before, but my biggest bugbear through the high inflation environment was with O2, because O2 increased my phone bill by more than inflation. They increased it by retail price inflation, which was running about 15% at the time. And I was just sat there thinking, you're just profiteering here. So now that the other side to that inflation is that they can't do that this year because inflation is going to be more normal. I'll try, but I might move my phone contract if they do.
I'm conscious of time. There's a question that's come in which we were going to touch on in a moment, but I'd just like to pick up on something you mentioned about 75% of the FTSE 100 value comes from outside of the UK. It's worth mentioning the so-called Magnificent Seven in America as well, which I know you've touched on in the previous quarterly economic updates. Do you want to just touch on what the Magnificent Seven are over in America and how that's affected the values of clients' portfolios?
Yeah, so the Magnificent Seven is the 7 largest companies in the US S&P 500. So it's Apple, Microsoft, Nvidia, Tesla, Alphabet, which is Google, Meta, and the last one's escaped my mind, Amazon. So there's those 7 businesses. And last year, the whole rhetoric around the markets was about artificial intelligence. And those companies, as you can kind of tell by their names, are at the forefront of that. Maybe not Tesla to a certain extent, but they're very much at the forefront of the AI revolution that's coming. And it is coming. You've seen it already start to be enabled in different systems that we use, and ChatGPT has been around for 15 months or so now. And what market participants like to do, and we saw this with the tech bubble, is they like to get excited about a story and they like to bid up and make companies more expensive. And that's what happened last year. Now, we haven't seen artificial intelligence come through and start to impact the market. So just let me get to one chart. Here you go. This is it. So this isn't the Magnificent Seven, but it's a top 10 within the US. So it's nearly there. And you can see the PE ratio. So if you've got a high PE ratio, it means the company's quite expensive. If you've got a low PE ratio, it means that companies are quite cheap on average. And the green bar there looks at the top 10 and how cheap or expensive they are. So it goes all the way back to 1996. And you can see what happened through the tech bubble was you had all this excitement about .com, websites, etc., and valuations became very stretched. And then over the course of the early 2000s and to 2015, you went through this period of kind of adjustment. Valuations fell and you got back to more normal levels. But then you've had the rise of smartphones and that technology, and that's really driven those companies on again. And COVID then kind of was another burst to valuations because, again, those companies benefited because we couldn't leave our house. We were reliant on Microsoft applications. We were all getting Amazon deliveries, etc. And that pushed those valuations higher. 2022, though, was a horrible year for these businesses and they performed very badly. And that's because they were very expensive and they fell very quickly. And then, as I said, if you fast forward to 2023, that right at the end of that line, you can see that green bar start to tick up. Those companies aren't delivering revenues from artificial intelligence yet, but the expectation is that they will at some point in the future, and their valuations have been reflected, have gone higher on the back of that. Now, one of the biggest risks when you invest in is what you pay for something, because our job is to buy things cheap and sell them when they're expensive. And arguably, what we did last year was we should be buying technology at the beginning of the year, but looking to exit as we got to the end of the year because the valuations were getting a little bit stretched. They're not at the same level as they were in the tech bubble. They're not at the height of the pandemic level as well, but they are certainly elevated at the moment. And I don't know who the biggest winners of artificial intelligence are going to be at the moment. And if you go back to the tech bubble, no one knew who was going to be the big winners there. Vodafone was one of the biggest companies in the FTSE 100 at that time, and they clearly haven't been a big winner from the internet technology. So for me, it's just about being cautious. We've been reducing our exposure slightly to the Magnificent Seven, that they are looking quite expensive, but they can get more expensive from these levels, and share prices can keep going up. Who knows when that'll happen? It's just on a balance of probabilities. I think now is a time to start to be a little bit more cautious about it and look at how much exposure you got to the US. And just one final point, Stuart, it's just about concentration. 30% of the S&P 500 is in 10 stocks. 30%. There's 490 companies which account for the rest. So for us, when you see markets becoming so narrowly concentrated, then that's a risk to be aware of as well.
Okay. Good. And I think when we've been talking about this, Alex, we've been looking at the macroeconomic and fundamentals, but obviously we've got the geopolitical pressures out there. Still got, we're looking at the issues in Yemen at the moment that's escalated over the last couple of days. We've still got the issues with Ukraine and Russia, which seem to be a lot more entrenched and longer than what people expected that to go on for. Obviously, we've still got Israel and Palestine. So what do you think the political problems, how do you think those political problems may affect the outlook for 2024? And I know that that's part of the sentiment and emotion that drives the economy and values, but do you want to just touch on how you expect to be able to mitigate any potential impact from that?
Yeah, so I mean, the first thing to mention is you don't like to see these things. I think it's horrific what's going on globally, and it's the humanitarian crisis that impacts that trumps everything. But as we've seen, when these issues come to the fore, then commodity prices at some way are impacted. Clearly that's come through, and why we went through that period of high inflation last year in the UK because of the Russia-Ukraine and natural gas prices and oil prices, etc. So if there's a major conflict within one of these nations, then it's going to impact that. And, let's just look at Taiwan. Taiwan's one of the biggest manufacturers of semiconductor chips. Anything were to happen over there, that's going to have a big impact technology-wise. So clearly it is a concern because it can impact the supply of certain commodities, which is inflationary. So I think there is a potential risk of inflation being higher and above the Bank of England's target for a longer period of time, because you do have these risks in the background that can come through. But you have to look at each incident independently. So Russia and Ukraine was massive because it had such a big impact on the oil price, and it has such a big impact on the natural gas price because they're so big producers. At the moment, the conflicts in the Middle East, they led to a small spike in the oil price, but they haven't impacted it massively. So it's actually come back down. So it picked up initially, but it's now back down to the levels that that was happening beforehand. So we had a little spike and back lower again. But there's other things that we need to be aware of with regard to that as well. It's OPEC in terms of how much supply they want to be producing on an annual basis. That's going to have a big impact. So you could see, excuse me, I'm getting over a cold as well. Could see supply increase to offset the impact. And as you say, it does lead to periods of volatility. What we do in periods like that is we look to take advantage of it. So periods of volatility, you see the market lowering and VIX and volatility indices higher. That to us is a good opportunity to launch structured products. So if you went back to the Russia-Ukraine crisis, that was horrible and the FTSE was impacted by it, but the market got used to it. We had the certainty because of the environment that was going to continue. And I suppose on the flip side of that, if there was a positive outcome out of that in some point in the future, which again, we hope so from a humanitarian perspective, but that could be a positive for commodity prices in terms of commodity prices coming lower, and that takes the pressure off inflation. So I think it's important to remember that it can go both directions. We seem to focus on what the risks are, but there's always opportunities that come from these situations, and even the easing of tensions globally could be a positive for markets as well.
I think it's right that without sounding Machiavellian about these things, volatility breeds opportunity. But in the short term, that volatility can look quite poor, and that's driven by sentiment and emotion. But once you build in fundamentals and look at the long term, then the opportunities are there for it to have a positive effect on clients' investments in the world economy as a whole.
Yeah, I mean, look, we have events all the time. We've had pandemics, we've had different elections, we've had tech bubbles. We've had interest rates going up, we've had interest rates going down, we've had wars, and long-term investors have not suffered regardless of all these events. Short-term investors that decide, I don't like this, there's too much volatility, and sell, they tend to do it at the wrong time. But if you're a long-term investor and you can ride through this period of volatility, then you tend to work in your favour over the long term.
Good. Well, Alex, thank you for your time. I'm conscious of everyone else's time. It's been booked out for an hour. Just to summarise, I think it's safe to say we've seen inflation fall quicker than perhaps what we expected, even over the last 3 months when we had the discussions and it was over 6-7%. Interest rates look to have peaked and perhaps could start coming down in 2024. We're already seeing that in the high streets. Being reflected in the remortgage rates and mortgage rates. Bank of England will want to get inflation down from current levels, today at 3.9 to its target of 2%. And we've seen, Alex says, some of the forward-looking analysts, they're expecting that to be in the 2s, so that's a positive. Global growth has been a mixture of strong US, you mentioned the Magnificent Seven, but strong US growth, and some of the FTSE large and mega cap, but slower China. Possibly that may reverse this year. With the UK, perhaps some value in the small and mid-cap companies, depending on what happens in the election. But I think it's worth pointing out with all of our clients that remember why you're investing for the long-term objective, and we shouldn't let short-term circumstances dictate what you should be doing for your long-term objectives. And if you do have any questions or any worries, feel free to speak to your advisor. Let's reassess risk. Let's reassess volatility. Let's make sure that any of your plans are still invested for the same objectives of when they were originally taken out. And if not, we can do some tweaking and relook at some of your portfolios and what financial plans you've got out there. Alex, thank you for your time as always. Our next quarterly investment seminar will be in April, so look out for the invite. Hopefully we'll have some more positive news. If there's anything that anyone wishes to discuss in the meantime, again, feel free to speak to myself, your advisor, or obviously speak to Alex direct. Thank you for your time. Oh, excuse me, we just had one other question. Oh no, it wasn't. It was someone thanking us for a great session. Mr. Jones, thank you very much. Positive feedback. Always welcome negative feedback. You can keep to yourself. No, honestly, if there's any feedback, please feel free to feed it in. And hopefully you like the new format, which is trying to be slightly more interactive. Thank you for your time. Look forward to speaking to you soon, and I will speak after Easter in the spring.
Thank you, everyone. Thanks for your time listening today. All the best for 2024.
Okay.
Bye now.